Okay, so I have started the recording, and if someone needs required, so actually within the interaction we got some topics and we can just discuss that topic. So what you do?
I'm actually in my first year masters in aerospace engineering.
Okay.
Yeah, I'm currently in France right now. So after from your WhatsApp and YouTube messages, I kind of
Hmm.
got interested into this financial thing. It is a good way to start. Even I
Yes.
spoke to my father, and he says, start slowly, start learning about this.
Yes.
Don't start like go full on now. Just learn about it.
Yes.
Then yeah, uh, slowly once you begin earning
Hmm.
little by little, minimum
Yes.
risk, minimal profits. That's
Hmm.
the strategy.
Yeah. And one more thing, always keep your investing as a passive income, not the active income.
Oh
Right?
yes.
Yeah, always do your work, your study, complete your study, do job, and always keep investing as your passive income, as a wealth creation. Right? So it do not make it as a active income. If you need that active income, you have to come in that trading itself, and the more the profit you need in short term, the more the risk you have.
Yeah, true.
Yeah.
Like what my father suggested was just mutual funds is the safe place right
Yeah.
now.
Yes, safe place you can save, but have you gone through my last video?
Yeah. I
Yeah.
didn't understand most of it, but I'm going slowly going through. Yeah.
Okay. So if you go through that, so I have told how what is the particular risk in the mutual fund. Actually, it is safe, but what is the risk? Why every mutual fund? Let me share my screen. Why every mutual fund has written there moderate risk, high risk, and means very high risk. Why they are writing that in their portfolio itself? Why they are writing? And in TV advertisement they always say that mutual fund to sahi hai, mutual fund is risk free or something like this. But whenever we are purchasing a mutual fund, they always written like, no, it is moderate risk, it is very high risk. So what is the risk actually? It has the risk is, it can be down or minus for 3 years, 4 years, 5 years, it can be. But you have to, what you have to do it, you have to invest for long term. If I say, mm, let me show you one more. So you can see that video, means you can start from half. Not invest now, I want to know more about. So let me show you for just a small brief about the mutual funds, why they have mentioned that the mutual funds are risky. If they are if they are not risky and they have nothing to do with our risk, so what are the things? Hmm, slide, no more. I want to see, view all. Okay. Oh, hmm. So I just want to show you the all the funds they have, just for okay. It doesn't mean that you will invest in that particular fund or something like this. I'm just telling like what is the difference in that particular scheme, what is the risk. Okay. So as you can see in my screen that even if you talk about any fund, means if you say that I have no knowledge about what type of fund I should take, whether it is small cap, mid cap, hybrid, depth fund or anything. So we don't know that which fund we need, right? So I will show you. I think the website is so slow.
It's SBI. Come on.
Yeah. It says actually, I have invested in SBI mutual fund, so I am keep going through this website, so I know where to check all this. So that's why I am on SBI mutual fund. But today it is too slow. Hmm.
Well, the
So if you
major
can see,
disadvantage,
sorry, what?
yeah, the major risk is the securities, right? A fund has some level of securities. If it goes down in value, then
Hmm.
it can, you have a loss. But the main goal is, a test match. We go long, 10 years, 20
Yes.
years.
Let's see. See, they are saying that they are giving 22%, 18%, or if you go through my last video, I have told why we need that. We have to beat the inflation itself, and inflation is like 6%. So all we need to focus is we need to beat the inflation, because the future value will be very less. If we need 12 12 lakh now, for our survival after 20 years, it will be 38 lakhs, right? So we need 38 lakhs after 20 years for our survival itself. So what happened, the every year 6% inflation if we add, so it become 38 lakh after 20 years, right? So if we need only 6% to manage the inflation, but they are giving 18%, 17%, 15%, 15%, 14%. So why they are so good, right? Even our FD rate are 7% and EPFO are like 8.5%, and they are giving 14%, 50%. It means like double of our return in FD. So why they are risky? Because they are saying risk rate high. Actually, what is the risk? If you see the return is about the average of since inception. It means it is saying for 26 years the average return is 14, for 29 years, 21 years average is 14. So same like this, if we just talk about our market itself, so small cap index was down for complete 3 years. It was down for like shares were down like 50%, 60%, 70%, even 90%, the stocks were down. And if someone has taken nifty small cap, so what happened to him? Obviously their return will be negative, right? Let me show you. uh, if you see, let me know. SBI small cap, SBI small cap, blue chip, corporate, ETF, magnum, index, technology, long term, hybrid. Yes, small cap, right? Let me open this. So you can see 18.45% for 11 years. If you have invested for 11 years, you will be getting 18% compounding for for the 11 years. But if we see the history of this small cap, you can see for the last 3 years it was giving only 4%. And those who have invested in small cap for in that particular 3 years, they will be saying mutual fund is very bad, mutual fund are too risky, and they are not even giving the return of FD. But actually what happened, the amount you must invest in mutual fund is the amount don't need in next at least 10 years. If you don't require that particular sum for the next 10 years, then you can invest in this. See the value, the value of per unit was 42 and it went to 28, right? And it was like I cannot see the previous one. It must be more down, like 15 or 16 in last previous months. A little bit performance we can see in performance. See, for the last 3 years what it was giving, 4.43. It was less than our FD itself. So that's the risk. When someone say that we have risk in mutual fund, so that's the risk. If suppose you need the money, urgent money, suppose if you need your urgent money and your mutual fund is down by like minus 10%, minus 5%, so it is obviously a risk. And the second time you will be much precaution, you take much precaution, like no, I will not invest in mutual fund, I will keep my money in FD itself. So basically, if you need more return, you have to you have more conditions also, right? If you need more return than FD, you will engage in EPFO. There you will get 8.5%. But what happen? There is a lock-in period. If you go to Smriddhi Sukanya, that account is for daughter, and you want that high return, and you want that I have to put my money for 15 years, and after 21 year I will get that money after compounding. But there is a lock-in period of 21 years. So that's the reason, if you need the uh, very too low risk, zero risk, almost zero risk and good return, then there must be a condition. So that's the same thing is with mutual funds. If you are if you want some good return, and they are telling that we are giving 18% since its inception, and but you need the money, so you have to wait for that 11 years also. If you have waited for 3 years, then you will get 4.4. If you can see that for the last 5 years, they those who uh, have patience and kept in this fund for the 5 years, they will get 15%. And who have just started, they will get 24%. So whoever getting the 24% in this year itself, they will say, wow, mutual fund are the best. Nothing is like that. Even share market is the worst thing, because I am getting 24%, and the person who is investing in share market, they are getting 20%. But they are not thinking about the next year. Their next year might be the 4% itself again. Then it will be average out. So that's the difference. You have to be a test player, as you say. So that's the risk only. The risk is not belongs to like the mutual fund will close and they will take your money and leave the country. It will not happen, right? So I think I have cleared this thing, like about what is the risk in mutual fund.
Yeah, yeah. Thanks.
Yeah,
Yeah.
yeah. So I have covered this thing completely in last video. If you have an time, like next weekend or next to next weekend, you can just go through it, because that's the reason I have that recorded itself. So what I have covered. I have covered that why should not we keep our money in deposit in saving account, because we are getting only 3% in any government bank or any bank. We are getting 3%. Not in the new banks, because new banks will giving you like 5%, like ISFC First, Fincare Bank. They are giving you 5% and 6%. But the inflation is itself is 6.7% for this quarter itself. So if you want to beat that, at least you should keep your money in FD, not in saving. Keeping saving account money in a saving account like 5,000, 10,000, 20,000, 50,000, that you need in urgent situation, like you need some medical situation or anything, or you need that money in within 5 to 6 months. Keep it in saving account, okay. But more than 1 lakh, no, you have to keep in FD, because you have to beat the inflation. Because if you keep cash in most of the what happen in India, most of the people keep the cash in home. So basically they are not realizing that every year the money decreasing by 6%. Means if they have kept 1 lakh in their home, so after 1 year it is 94,000. And they are thinking like, no, it is 1 lakh 10 years ago, and now 1 lakh after 10 years. They are not counting the inflation itself. No one is counting, because in India only 1% are investor. Only 1%. So only 1% are doing investments, and other are doing just saving and just means uh, paying their bills and saving and paying their bills, saving and paying their bills. Even if they miss the credit card payment, they are giving 18%, and but they are happy with 3% of saving. That's the reason I am telling you that do not keep your money in saving. Why investing? Because you have to beat the inflation, and the investing is all about the long term. It's like wealth creation. Warren Buffett started is investing at 11 at his 11-year age, and now he's like 89 years. And the compounding he is getting like every 2 or 3 years he's getting doubled his money. Like he was uh, till 40 or 50 years he was like 3 billion, 7 billion, 8 billion dollar his worth. Then next year it become 14, then next year it become 28, next year it become like it is going on and going and going on, and now he is like fourth or fifth richest person in the world, right? And he is not even bother about money. He don't even have the laptop and phone. He just love the investing thing, and he's keep doing it, keep doing it. As you know, the Apple or Coca-Cola, his the favorite investment, and like he has the share of like 15 or 20% in iPhone, Apple. So why diversification? As I told you, you don't know that which thing will be the best for you. If you suppose if you have kept your money, all money in mutual fund, yeah, mutual fund is giving 15%, 18%, 20%, and you kept all your money in mutual fund, and what happen if for 3 years it will be down, and you know that yeah, I have to be uh, patient, and I will keep that money for 10 years and it will be okay, right? Okay. But what happen the same year you are going to take out your money, and that year there might be a recession or anything, and it is down like 50%. So what will happen? So that's why the diversification is very important. Keep your that emergency money in FD or liquid fund, and rest amount in mutual fund, and rest amount in EPFO, or anything like different. You have to manage that thing. I can tell you that like what can be the scenario, what can be the options, and that's the you have to take your risk. Some have like 1 crore in cash itself, and they are not bothering about it. They can do anything for it. And some have only 10,000. What they can do, they cannot put that money in FD because they need that in urgency, right? So different people have different choice, and they have to work on that. So I can tell you about the basic thing, and you have to work on your own investing thing. Buy asset and sell liability. Actually, we have very good discussion on this thing. Like I have 270 traders in my group, in my where I do regular trading. So there was a one discussion on the home, like should we buy home or not. I want to ask you, should you buy your home? You require a home, and you should buy a home first before anything like big anything doing, like you want to have a manufacturing industry, you want to have a good portfolio investing portfolio, anything, or you should buy a home at least. It is a basic requirement. What do you think? Any of you? The more you discuss, the more you will get.
Yeah, can you repeat?
Yeah, I want to say that what you think, like buying a home is a good thing, is a basic requirement, is a basic essential thing, or you can see like, no, I will save that money, or I will make my investment at this age, and I will buy a home later stage. Or you think that no, at least a home is must, first we should buy a home, and we should buy a home, it is a basic requirement, and it is not a liability, it is a asset. You are getting my point? A home is a asset or liability, and you should
Okay,
buy it or not, or you should invest
okay.
that particular money in something else. That's my question. Anyone,
Okay.
Pranav, Vidyut, or Bomik?
Yeah, liability. Yeah.
Yeah, okay. And Bomik is DRES, right?
Yes.
Okay, so what do you think, DRES? If buying a home is a liability, means it is a burden, or it is an asset, or it will be a very good thing. What you will say? And with you?
See, if we already have a place to live,
Okay.
then it is a liability.
Okay.
Sorry, then it is a asset.
Okay.
But if you don't have a place to live, or
Hmm.
you live on a rent
Hmm.
or monthly basis,
Hmm.
then it is an asset. It is, uh, how do you say it? See, living on rent is always an option.
Okay. Hmm.
But when you have a fixed monthly income,
Hmm. Okay.
if your uh, income isn't fixed, then buying a house
Hmm.
is important.
Okay. So basically, you are saying that if you have a fixed income, you can keep giving rents, and you can maintain your living thing, right?
Yeah,
And
and we
if
can
you
invest the profit or the extra money that we have in other things
Mhm.
like mutual funds or trading.
Yes, yes, yes. And if you are saying that if you are do not have a regular income like to pay the rent, then a home is an like a asset, because you can at least be in a home. You have at least a roof, right?
Yeah, yeah,
Yeah. Okay. And Vidut,
exactly.
what you say that
No, yeah, it's a liability. Of course, it's a liability.
yes,
There is no need to
actually,
invest
yeah,
20,
yeah.
30, 40, 50 lakhs
Hmm.
just for home.
Hmm.
Obviously, you will take loan and all that. That's why.
Okay. Yes. Actually, just I think in my mind, if I have read for the last some years, the home is only thing that is can be a liability and can be asset. Both are the option for the home, because home is a liability for half of our population and asset of half of our population. Don't you see that people are buying so much home, and they are keep it on renting, keep giving on rent itself, and they keep buying another property, keep buying, and they are giving it for rent. But I know what is your point, that we are not getting that particular amount, particular return from the home. What I have told in my group itself, that we are getting, if we even purchase a property of 60 lakh, you will get maximum to maximum 21,000 rent, and it will be like 2 lakh, but whatever it is, 2 lakh 40 for 2 lakh 60,000 you will get as a rent for a 60 lakh property. It is like 4 point something percent, and you are getting 7% in FD itself, and you're getting 8.5 in EPFO itself, and you are getting that 14-15% in 10 years in mutual fund itself. Then why you are satisfied with the 4% return? So here is a thing, like, so when you buy a property, the price of property itself increase, so the appreciation of price we cannot neglect, right? So when it become a liability and when it become a asset, in there the little difference. Like, if you buy a property for your own, it is a liability, because when you buy a property, suppose you have fixed everything, like, okay, I have taken 1 lakh loan and 1 lakh property I have taken, and I will manage every and other thing from my salary. Okay, that's it. You have zero burden right now. But when what will we increase with that? The property, you need the furniture itself, you need the painting every 5 year or 6 year. That's the liability. You have to pay the tax, property tax. You have the repair thing, you have something and something and something, everything will be coming and coming and coming. So that particular thing you have to keep uh, from your the expenditure from your salary itself for home. The home is not giving you anything. Okay, the amount, the property price will increase like 4% per year, that's okay. That you are getting a home and the price appreciation is there, okay. But that's a liability, because you cannot use that other money anywhere, and you are not getting anything from that particular home. It is all about like the you have all the expenditure plus your home, right? And when you have the all sufficient cash with you, suppose you have 1 lakh cash, and you are thinking like, what should I do with this money? Okay, no, not 1 lakh, now you have 2 lakh, and you are thinking like, what should I do that particular 2 lakh? I should buy a property or put that in my bank, because property will give me 4%, and that money in bank will give me 7%. Then you realize that if I diversify now my money, I will buy a property of 1 or 1.5 lakh, and the rest I will keep in property. What will happen? The 4% I will get the return, the what rent, and the 4%. What if I will get at least 3% appreciation in market at later stage? Then there is a net issue, or what? Are you getting my voice?
Yeah.
Yeah.
Got it.
So
Yeah.
that's the issue, that you have that sufficient money and there will be no liability on your next income. The particular income you have, there will be no liability. What you have to do, the rent you are getting is the extra cash flow in your, extra cash flow is adding in your total income, that you have to that you cannot neglect that thing also. That okay, you are getting now the appreciation on the your property rate, or okay, and you are getting 4% every year. That is the extra cash flow you are getting. But how it will be helping you, that suppose you have a 20-year lockdown in EPFO, and every year you are getting that 4%, that rent, that 20,000, 21,000, you can use that particular amount in your daily expenditure. You are not using any extra money. That how the cash flow works. That how you will get the uh, uh, you are getting that particular property as a property, and now you are getting that no extra expenditure, and you can use that extra cash flow, and that extra cash flow can be reinvested. You have neglected that thing also, right? You are getting that particular amount after 20 years, that's okay. But what you are getting right now, you are getting every year 21,000 per month. It means you are getting 2 lakh 60,000 approx, 63 64,000 approx. You are getting every year, that you can reinvest, and you can get 6% or 7% on that amount also. You are neglecting that thing. So that's how the cash flow works. And they keep, and if you talk about the compounding after 20 years, the amount you are getting in FD, it must be the same amount that you are getting on your reinvestment. So there are many things you have to taken care about. And there are many things we just uh, what is this, running out of time? uh, oh, I don't know if it says that we have 10 minutes, and I will share the next link after that. I don't think it will be get disconnected after 10 minutes, because I think there is a unlimited minutes now
Yeah.
in
The
Zoom.
Zoom feature. Yeah.
Yeah,
Free is only 60 minutes. Yeah.
yeah, 40 minutes, but I
60
think
or 40.
yeah, it is
Yeah.
40 minutes, but I think last time it shows that enjoy the full timing. But if it get disconnected, I will share the next link within 1 minute in that group itself, right?
You just need to restart the minute meeting. That will reset the timer.
Okay. How to reset that timer?
Like leave the meeting and start it
Okay,
again.
yeah, I will share. Yeah, I will. It can be possible that the same link will work, or if not, then I will share
Yes,
the
the
different.
same link will work.
Okay. So now you are getting the point. My point, that why assets and liability are more important, and how to why buy assets and always sell your liabilities. If you are getting money and you have, wow, I have 5 lakh, let's buy, let's invest and some spend. So what you are going to do, you are going to do like 2 lakh in FD, 2 lakh in uh, in mutual fund, and 1 lakh, let I will buy a bike. I will buy a sports bike of 1 lakh, like Pulsar or anything. What it is a liability. You have to, you need the petrol, you have to service, insurance. The insurance amount of like 1700 or 18,000 itself your particular rent, if you take the auto or anything for the month to your office. So I'm just telling it, not like you should not buy a bike, because sometime it happened that bike is more cheaper than your daily expense. Okay, so do not get that point wrong. I'm just telling that what is the how to buy asset and sell the liability. So instead of that particular 1 lakh, you can what you can do, instead of buying bike, you can use that daily local transport like metro or anything, and you can invest that amount in your FD. And after 5 years you will be getting like 35,000 on that 1 lakh. And that's how you can now buy a bike, and you have more 35,000 for your petrol and everything, and even giving party to your friends. So I'm just telling you that how
Yes.
investing thing works. You have to be keep patient. You have to you just not need to save your money, you have to invest that too. If you keep your money that 1 lakh in your pocket for 5 years, it will become like the future value of that 1 lakh will be like 80,000. So that's how the assets work. And because the if everything has the inflation of 6%, obviously the property will also have like 2% or 3% inflation. So we have to calculate that also. So there the small things we have to be worried about, we have to be calculated. But since we are the beginners, we do not need to go in that much deep. We can just do a small thing like diversification. Do not put more cash in our saving account. We can put the extra money we do not need in for the next 10 years in our mutual funds or EPFO or Smriti Sukanya or PPF. Those all are giving the more return than your saving account or FD. So that's how you have to go through different things. Which is the best for you, you have to decide and go with it. But never put your all your eggs in one basket. If one basket broke, your all eggs will be broken. And so always keep your uh, take at least three basket with you. So diversify at least in three things, not in one or two. So if you have read my message, why not gold? As you know, the gold return from the last 5 years, 10 years, let me show you, is equal to the market, share market itself. Okay, let me show you gold return from the last 20 year. So it is giving 8.8%. And I think the gold is beating Sensex this year because as you know, the gold was like 40,000, and now it is more than 50,000. So appreciation of like 25% in this year itself. But don't think like, yeah, I will buy the gold of 100% of my capital because it is increasing like 25%. As I told you, next year it can be just 4% or 2% or minus. Okay, so that's how you have to manage. That's the thing, the diversification works. So you will put 50%, even if it down, the market will up, so it will average the amount. So basically you have to focus the average amount. You can just focus like 10% per annum, 12% per annum as an average. So something is giving 18%, some is giving 8%, it will be balanced and will give you 12%.
What is
Okay.
a gold bond?
Gold bond, it is like ETFs, gold ETFs. Gold bonds means like government bonds. They have government bonds, like government is selling a particular bond and they are telling you that it is a real gold, you buy from us, give us money. And when it is in everything like corporate bonds. What mutual fund are doing, suppose you are giving crore, lakh crores or 1,000 crore, 5,000 crore, what they are doing with the money? If they keep it with them, so it will be depreciated because of inflation. So what they are doing, they are investing in different things. If they are investing in share market itself, they are investing in gold bonds, and they are investing in corporate bonds. What happen, like corporate needs money, a company need money, a government need money. So what they issue, bonds. They issue bonds, they give a piece of paper to you, and that value same as the gold. They are telling you that now the gold price is like 40,000, and you buy a 21 kg gold, and you will get it for like 40 lakh, right? Okay, and give us 40 lakh, and this keep it a piece of paper with you, and we will give you 6.6%, 6.7% return on it. So it is a gold bond or corporate bond. That's how they work. So after 5 years, they will take that particular certificate or that piece of paper from you, and will give you the amount plus the percentage of the return you are getting. That's how the things work. So the corporate bonds are like sometime they are like 11%, 12%, 8%, 7%, 6%, and anything, because sometimes the company is more riskier, so they are not getting money from banks from at the 8%, so they release the government bond, the corporate bond at 10%. So somehow they will get the money. The mutual fund invest or put their money in some riskier asset, they will go for the 10% corporate bonds, and then they will give our money to the company, and somehow they will manage to show growth of 20%. So company will keep their 10% and will return that particular 10% to mutual fund or banks, and that 10% will be returned to us. Somehow company do not manage to make that particular 20% growth, and they are making just 5% growth. So that's how they default. Then they default that money, and you can see everywhere that yeah, we have to create provision, that company is bankrupt, that company is not able to pay our loan, and they are bankrupt. We are making provision means we have to keep that money as a NPA, non-performing asset, and things like the cycle goes on like this only. So if a company is very good, every bank will be will rush to give loan to it. Even Tata needs loan. Everyone will be okay. Yeah, yeah. I will be give. I will give. I will give. So they can demand. No, I will not take the 7% corporate loan. I will give 6.6, and I will be happy. Yeah, at least we are going to get 6.6, and there will be no fraud from Tata. So that's how the corporate market works. And same with the government. Obviously, government cannot default your money, so they are giving just 5.5%, 6%, 7%, or even 4% on government gold bond. So it is like same like you are getting the gold but on paper. And you if you buy if you want to buy gold or invest in gold, that's how in market, then there is a ETF, gold ETF. So same like you are buying